You can tell a lot about yourself by the way you react to something that you had not anticipated, especially when it comes to money. And this is usually not something that you can analyze in the moment. If you were an investor in the equity markets in 2020, I want you to think about the reaction that you had in the month of March. I, for one, was on a holiday, and for the most part, blissfully unaware that the equity markets were plummeting. I'm not sure when I realized, but I distinctly remember looking at my mutual fund portfolio and seeing that it was in the red by more than 30%. I remember that visceral fear that my savings had evaporated in just a few days. Equally, I've been guilty of going overboard when the equity markets were on a bull run, making all of us feel like kings and queens and like we could do nothing wrong. Greed and fear, two opposing factors that dictate the course of capital markets, and the way that you navigate them determines your individual success. Doing this well is easier said than done, though, and that's what I want to talk to my guest about today. Joining me today is Ashish Somaiyaa, Chief Executive Officer at WhiteOak Capital Asset Management. Ashish, thanks so much for taking the time.
Thank you. Thanks for inviting me.
So I'm hoping that people remember this, because a lot of people started out at that point. They bought the dip, so to speak, or entered at that point, and a lot of wealth was created. But those people that started in September of 2019 saw the crash. I was lucky enough to learn from that, I think. And I saw this interesting post that you had on LinkedIn, where you were talking about meta thinking, which is thinking about thinking.
Yeah.
And is that the key?
Yes, Alex, I just realized, because, I'm lucky enough to meet a lot of people and observe many people and their thought process, etc. So one thing I've realized over time is that everybody spends a lot of time trying to figure where the market will go. Everybody tries to predict the course of the markets. And what I've learned is that, markets are not predictable, but irrespective of where the market is, how people behave, how they react, that is kind of, that carries a lot of insight. So you may not know which way the market will go, but just by observing how people are conducting their affairs, or even by observing how you are feeling about markets, you can get a lot of clues in terms of the market direction. So, meta thinking obviously is something which differentiates us from other species of living beings, because we are one of the only species, probably the only species, where we can think what we have been thinking. We can analyze what we've been thinking. More importantly, we can even analyze how we've been feeling. So, if you find, if you react to the market in a certain way, before you actually act on it, you can think how you have responded in similar situations in the past. And when the market behaved this way, say 5, 10, 15 years back, at that time, what did you feel and how did you react? And also by observing what others are doing. So I think thinking about how you think, or thinking about how you're feeling, it has a lot of clues. So don't waste your time predicting where market will go. Invest some time in observing how you are responding, and more importantly, how people around you. The last thing, like say, Mr. Buffett is often quoted to have said that, be greedy when others are fearful, and be fearful when others are greedy. You know what? The most important word in that statement is others.
Yeah.
And the clue to success, the key to success is not to be part of others. And how can you ensure that you are not part of others unless and until you observe what the others are actually
and you
doing.
are in that cohort, essentially, because you cannot remove the experience of fear and greed. Look, this is written about a lot. Fear is not, or conquering fear is not the absence of fear. It's what you do once you have experienced that fear. And so therefore, even from an investing perspective, from a lens, you have to understand what that feeling is. And it's quite a I said visceral. I'm telling you, I was on a beach and I looked at my phone and I'm like, no, what? And my wife was looking at me, and we were pretty much one year in from our marriage, and she'd given me all the money to manage, and I was like, how do I tell her that it's down 35%? So it teaches you stuff, doesn't it?
Yeah, absolutely. See, I mean, if you don't want to be part of the others, as I said, of course, we are all part of the others. We are all part of the crowd. But every once in a while, our past experiences and what we glean of what the others are doing should enable us to kind of a little bit, stand apart. Because as they say proverbially, you buy when there is blood on the street, including your own. So unless and until you are observing how others are reacting or how you yourself are feeling, how will you bring yourself to actually acting against your own worst fears, right? Like you rightly said, fear, overcoming fear or courage is not about not having fear.
Yes.
Courage is about recognizing or validating that I'm feeling fearful and then kind of going beyond it. So how do you bring yourself to act against the crowd? You cannot do it unless and until you have observed how others are feeling, how you are feeling, and then, kind of take a step back and then, tailor your response.
But equally, Ashish, would you agree that acting against the crowd, you can look at it in retrospect and say it was right. But in that moment, it's not always guaranteed to work, right? So for example, let's talk about COVID-19 and let's talk about the week up till the 21st of March or 22nd of March, whatever that was, when the Nifty 50 fell 13%. In the run up to that also, it had fallen 5% one day, 8% one day. You could have thought, oh, wow, it's fallen to this point, it can't fall further. And you've deployed whole hog. You've taken all the money that you had lined up. And you said, okay, you know what? It can't fall further. And you've deployed everything. But it's fallen 13, 14% after that. So there is danger there as well.
Yeah, so I have a couple of clarifications to make. Good you brought it up. See, it's not about thinking in extremes. Right, so when we say that be fearful when others are greedy, or when we say buy when there's blood on the street, and I want to throw in one more example here. We always say that the stock market, over the last 30-35 years, it's compounded 14-15%. All those things we say. So long range compounding is 14-15%. But Alex, pretty much every calendar year from its high point, market does fall 14-15% or 20% once, right? So there are enough opportunities to act against the crowd. But the key thing is not to think in extremes. Like, say if in 2019, 2020, let's say market started falling, or even say recent times, 26,000 was the peak of Nifty, and then we saw it go all the way to 21,700 at the low point. You don't need to think in terms of, all
Can
in.
you catch the bottom? Yeah, and
right?
yeah.
So basic point is you need to calibrate. See, we know that the long range return is 15% compounded, but we also know that every once in a while market does fall 20% from its previous high.
Sure.
Now, I don't know whether the bottom is 20% or 30%, but the fact that on average, every year it falls 15-20%, the moment it goes below 12% from the top, can I start throwing in some, let's say if I'm doing an SIP, can I throw in one extra installment or two extra installments? So don't think in terms of extremes. You're not trying to catch the peak, you're not trying to catch the bottom. But every time you find that it is 10-15% below the peak, can you start throwing in a few extra installments into your SIP? And the other way, opposite, when the market is expensive, let's say that long period average is say 14-15% compounded. Every once in a while, like recent times we may have seen that our portfolio is showing 25% compounded return for last 3 years, for example. And then we start thinking, wow, I'm the best investor or the best.
You feel like a king or a queen.
But the point is that if the long period average is say 14-15 and your portfolio is currently showing 25, what does that tell you? Again, you don't need to think extreme that, okay, remove all the money from equity. Can you start reducing or calibrating? So we need to think in terms of continuums. We need to think in terms of calibrating. We don't need to think in terms of extreme steps. You know what, like in 2020, if somebody says, okay, let me leverage, let me borrow against my house and put money because market is 40% down. That is crazy. That is thinking in extreme terms. That's not what we are talking about.
Is that also true in the selection of the schemes that you do? Because look, the data will show. Look at the data that's put out by the Association of Mutual Funds, the AMFI data that comes out every month. You'll see that the largest category by far is sectoral and thematic. You will have a significant amount of money that has gone into small cap funds, significant amount of money that's gone into mid cap funds. I know for a fact that your fund house decided to hold back on the launch of a small cap fund at some point.
We don't have an open-ended small cap fund.
And so I understand why you've done that, but this extreme way of thinking and this idea that a tactical allocation, because I think that banking is going to be the next big thing, and having 30%, 40% allocation to one sectoral fund or thematic fund, even though it's broad, to say, okay, I'm not doing a banking fund, I'm going to do a financial services fund because it also includes insurance and mutual funds and asset management companies. But it's a flawed thinking. But so, why is it a flawed thinking?
So I'll tell you, see, what happens is that we all need to be mindful of the playground we are playing in. We all need to be mindful of what I call base rates. So let's look at it this way. If you look at our stock market construct, the construct, let's look at by market cap first, because you mentioned, say, small cap. If you look at the entire market cap by construct, we are still about 60, 65, the market in the long period average is still about 65 to 70% large cap and 30 to 35% small and mid cap, right? If you think sectorally, the market is still 60 to 70% banking and financial services, IT, consumer, maybe healthcare, right? But when you say that people have been putting bulk of their money, and I actually did the math, in the last 1 year, you can imagine almost 40% of all net flows went into thematic funds.
Yes.
And then you add small and mid cap to it, you would imagine that 70% of all flows went into small and mid cap. Even if you talk thematic, it's not like money went into the big ones like banking or healthcare or IT or consumer. It all went into narrow segments of the market, which is, say, PSU, energy, railway, infra, defense, etc. Right? Nothing wrong with it. The point is why I talked about the playground and the base rates. You look at it in terms, sometimes you order to go to a restaurant and order thali, right? When you see a thali in, say, in southern India, Alex, the thing you see big and in the center is rice. And then there is, certain, the utensils are arranged, and then there is somewhere where there is some chutney and there is some pickle. Imagine a thali where green chilies pickle is placed where rice was to be placed, and rice is placed where chilies were to be placed. And then I consume that thali, and then I come and ask you, Alex, what do you think is the impact of Mr. Trump's pronouncements on my portfolio?
In any given year, you have a situation where a sectoral or thematic fund is the best performing scheme of that year. It could be an infrastructure scheme in 2024. It could be a defense scheme any other given year. And so therefore, can I select the next winner?
So that is a game which that's a game which it's fascinating, but you just can't win, because in 2024, ultimately, in 2024, all our conversations were dominated by PSUs and energy and defense. But surprise of surprises, in the calendar 24, the best performing sector was healthcare, actually. It was up nearly 40% for the calendar year. Right? People would have started the year thinking it will be PSUs or PSU banks, but no, it was actually healthcare. So the point is that even this year, we don't know, it's mixed. We don't know which sector will actually end up on the top, right? And if you follow the theory that, we need to think about how others are thinking, then maybe digital and IT is actually the most contra bet today, correct? So I think
it's not affected by tariffs.
Yeah, exactly. So now, what I'm saying is that people want to people want to identify the next winner. But the point is, even if you want to identify the next winner, there is a way to participate. You don't bet the house. I mean, you can't, as a sum total of investors, mutual fund participants, they can't be putting like 70% or 75% of the net inflow into sectoral funds, thematic funds, and small cap funds, right?
Small funds.
And even if you talk about sectoral and thematic funds, even if it was banking or digital or consumer or healthcare, I could understand, because they are big parts of the market, right? They are not exactly rice, but they are at least, say, veggies or the chicken, right? But when you pick something which is not even 1% of total market cap, and then you have 15% of your portfolio allocated into that, then you're calling for trouble. Because at the slightest hint of any shift in the market, you will find yourself playing in a completely different playground, isolated all by yourself.
So, but that's the danger.
Right.
That's the danger that you're highlighting, Ashish. But people who've experienced 25%, as you've pointed out, they want to keep experiencing 25%. And so therefore, they will say, the only way for me to do this is for me to pile on the pickle.
So the probability of experiencing significantly high return in some part of your portfolio is if you are well allocated, right? But generally what I find is that people chase a theme after the 25% has
already done.
Right? See, the entire market will experience 25-30% return only if you catch COVID. But one particular sector in which you allocated and that sector outperformed or outshone the others and you got 30% on a sizable part of your portfolio is like calling for too much risk. There are very few people who catch it. In fact, most people, as we discussed, most people put the money after the performance is delivered. Right? See, when did people put maximum money into PSUs or energy or defense? It was mid 2024.
Yeah.
When did we see maximum money going into small cap? It was early to mid 2024. Right? Did we see maximum money going into healthcare funds in the end of 23 or early 24? Answer is no.
No.
Right?
Yeah.
So,
you saw it towards the end of 2020.
Yeah. So what I have seen is that usually speaking, money comes after performance comes. And performance goes away after the money comes.
Yeah.
So I think the best thing is that, it's better that you keep the lay of the land in mind. Make sure that your portfolio allocations are somewhere plus minus of the broader, that's why I said keep base rates in mind.
So from that perspective, and obviously that conversation then comes to asset allocation, it comes to sensible, pragmatic diversification of your investments.
Yes.
Because in any given point of time, a particular sector, or three, will outperform the others.
Yeah.
At any given point of time, one particular asset class is going to come to the foremost.
Yeah.
You saw it with gold.
Yeah.
And the comparisons that are drawn to the Nifty 50 over the course of a decade and the fact that it's beaten it hands down.
Yeah.
A lot of factors go into that. The fact that central banks have been buying and there's a de-dollarization that has taken place over the course of the last 5 years has gone into that.
Yeah.
The average person is not going to be thinking about all of that. So therefore, what is the key to having a good diversified portfolio? Sure. You have to buy into being willing to get lower returns, right?
So I'll tell you, first of all, when you say buy into or show willingness to get lower return, the way to think of it is that whether it is life or business or investing, it's all about optimizing. None of it is about maximizing. People who try to maximize, more often than not, run the risk of Mr. Market turning around and minimizing them. Right? So if you try to maximize, every once in a while the market will turn around and minimize. So it's better that you try to optimize. Second thing, while we were talking, I just want to clarify one thing. I'm not saying that you should never bet on something which you feel convinced about.
Okay.
Let us say, for example, right now, in my own conversation, if I say, not a recommendation, but just for example, if I say that tech and digital seems to be the contra bet. So I'll say, okay, in the broader market, tech is 8 to 9% of BSE 500. If I'm feeling extra bullish about it, so how much of my equity portfolio will go there? Maybe 15? 18 tops, right? Will I redeem some 10, 20% of my portfolio and buy everything into tech? Not really. It's just about being slightly overweight or underweight. You don't bet the house, really speaking.
But you say this, but yet we do another show on a daily basis. It's Ask Profit. And I get callers, Ashish, that have one stock that has done incredibly well, that is giving them gains of 1 crore plus. I've had this, okay? It's a little known infrastructure company. It's done particularly well.
Yeah.
And this is accounting for 60-70% of their portfolio. It's one stock.
Yeah, but they'll have
It gives me the palpitations.
They'll have to bring themselves about to take some money off the table. Because see, there is another learning, which, like I'm nearly 50 years old, so I can say all this and some people may not be able to relate to it.
Yeah.
But there is a reality that you never question your decisions based on the outcomes. So if you tell this person that, sir, 70% of your portfolio is in one stock, you should take some money off the table, right? Then you say, but Alex, what if it goes up another 50%? First of all, a lot of the times it's not well researched, right? You bought it for a certain reason. It's gone much further than what you ever thought in your wildest imaginations, right?
In this case, it's well researched.
Yes.
He's looked at the land holdings. He said, oh, the value of this is X, the market cap is X, and so therefore it should be.
There are so many determinants, Alex. So what I would do is that I would take some money off the table and diversify it. I'll tell you the reason. The reason is because knowing fully well that it can go up further. So that's why I'm not taking all the money off the table, right? Second thing, if it goes up further, and when I look back at, why did I take some money off the table? I should always be mindful that probabilities and the alternate reality could have been something else, right? Some news can come and the stock can tank.
Yeah.
So my point is that it's all about optimizing. If you try to maximize, let's say there is a juncture when you thought, oh, I should have sold, and then the stock is 50% down. Even that can happen, right? So we are dealing with uncertain outcomes. We are dealing with probabilistic outcomes. At any juncture, you need to see on balance. In future, anything can happen. But today, where I am standing at this juncture, what do I make out of this situation, and what do I think is the right thing to do? You have to judge your decisions based on that. Today, where I stand, how am I feeling about it?
Yes.
Based on that. And you cannot bet the house. It's about calibrating. It's about optimizing.
Let's talk about this. Let's talk about asset allocation, because ultimately this is something that is incredibly important. And yet, the need to keep things very, very simple, because simplicity at the end of the day is what will hold you through the long term. Complicated products tend to confuse you more than anything else. In your opinion, what should be included in a good, diverse portfolio? Because invariably, we've spoken about thematic, we've talked about small cap, but equity as a whole, in several cases, forms 95, 100% of a person's portfolio. And this is pretty common. So what should be part of a portfolio, in your opinion? And I'm not asking you to recommend anything, but I'm asking you to say what are the components?
So let's look at it this way. There are indeed, I agree with you, there are indeed some people who have 95 to 100% or everything in equity. And then, so they need to live with that. And then, one would presume that these people are not dependent on their investment for their income. They have a steady monthly income. Second is, you presume that if 100 becomes 70 or 80, they're not going to lose sleep at night. So let's say there are some people who classify themselves as out and out equity investors. They are the risk takers. They don't lose sleep over any market fluctuations, and they are not dependent on the portfolio for the income. So leave them aside. But for large number of people, right? For a large number of people, the fact is that whatever they may say, if the portfolio is 20% down, they do lose sleep. And then that will impact their ability to remain invested. And then they will also end up making wrong decisions when they see 20% down.
Stopping a sip or pulling out.
Yeah, exactly.
We saw quite a bit of that.
We saw that a few months back. We spoke about it. So what happens is that there are a lot of people for whom the market movements, their mind starts playing games with their decision making and their risk appetite. So these are the people clearly who are not suitable for 100% equities. For them, asset allocation matters. And then what will happen is that then they'll have to have, stuff like equity, fixed income, and gold. Now, say gold is something which you spoke about. I always tell people, if you want to have gold in your portfolio, it better be 15-20%. Because then that gold in your portfolio will ensure that it dampens the volatility of your equity. A lot of time what happens is people have gold in the portfolio, but it's 5%, 2%.
It's not enough.
You'll just feel good when gold price goes up. You will feel good that I have gold in the portfolio, but it doesn't do anything to dampen the volatility of the equity. So clearly there are two types of people. One, who are out and out risk takers, equity guys, don't lose sleep the way we discussed. The other is people who, they want a steady portfolio. They don't want to see wild gyrations. They want, you don't want their emotions to come under question at any point in time. So for all of those, asset allocation is very important, and then it has to be across multiple assets.
And ultimately, a 12% or 12.5% appreciation every year is not terrible. It is something that is going to cause your money to double every 6 years.
See, the latter type of individual which I described. People who cannot take wild gyrations in the portfolio. See, they will be able to enjoy that compounding only if, compounding you can enjoy only if you stay put, right? And for some people to stay put, smoothing the journey is important. For some people, a wild ride, they don't react to it and they remain invested. So despite the wild ride, they may, enjoy the compounding. But for some people, when the market is very volatile, it is impossible to stay put. Then how are they going to get the compounding in the first place? Right? So for a lot of people, it's very important that instead of 12, if they get 10, no harm, but at least they'll stay put. And for that, people either they need a great advisor, or they need to listen to what we are talking, or they need to keep their emotions in check. You need to recognize yourself as a personality first. And never assess your risk profile when the markets are booming. now last 1 year return is zero.
Yeah.
Now people should assess their risk profile, right? Because last
Because
1 year
it's gone
gold
down.
has done,
Yeah.
last 1 year fixed income outperformed equity,
Yeah.
gold has outperformed equity.
Yes.
If it remains like this for another 6 months, people will be really, soul searching.
Yeah.
And then both these types of personas will come in question.
Absolutely. On that note, Ashish, thanks so much for taking the time.
Thank you.
And I would invite all of you to write in and tell us what you think about this. Think back to a situation earlier this year, even when the small cap indices or the small cap and the mid cap index lost 20%. What did you do at that time? Did you double down? Did you invest further? And did you enjoy the ride up? Back 20%? Let us know. And thanks so much for watching. This is NDTV Profit.